Welcome to the Best of U.S. Investors Two Regular Guys show. I got Mark over here, over there, and
Yeah.
myself, Trent. We are going to today dive into yesterday's epic decision to lower Fed funds rates by 50 points and what this actually means to you and me, the regular people of our great country called the United States of America. So
Yep.
let's get going.
Yeah.
Hey, Mark.
Hey. So I don't know if you watched what I call the Federal Reserve Clown Show yesterday,
Oh,
but I did.
the whole thing.
Yeah, and I was like, what world do they live in? They must live in Janet Yellen's world because we on this show and in our platform, the Platinum Channel, talk every week, and we go through all these government reports and we dig deep into these government reports, past the headline numbers that Steve Leisman looks at. And, on page 492, it says, economy's great, we're doing good, and the consumer's resilient. And we go and show really, you know, what's really happening. And yesterday, I was really disappointed in number one, the Fed going out there and doing what they did and then saying everything's normal and fine. And then on the other hand, uh, the press not asking questions that really pertain to regular people like us. You know, people who are saying, "Oh, the well, the Fed says that the inflation rate's almost at their goal of 2%." Well, they don't talk about how much higher the inflation rate is compared to 4 years ago. Okay, we're up 30-40% on most things. Okay, go to the grocery store. Are we at 2%? Did we go back down to where it was? Heck no. Okay, did your paycheck go up to cover it? Heck no. We're still in the same situation, but they're taking the same reports we look at and they make it a rosy picture. And so I'm going to go through a little rant here. So be patient on how I see it and how I see it affecting just regular people. Okay, like you and me. And I know you're fighting at the grip there that shows some charts too. And let's just get going with it. And so really, yesterday the Federal Reserve cut its benchmark interest rate by half a percentage point, marking the first rate reduction in over 4 years. And we've been waiting for this rate reduction and forever. And the market today is Thursday, September 19th, just about noon Central Time. So the markets are up. Everyone's happy. The market's up. Remember, the market is not the economy. The Federal Open Market Committee voted 11-1, and one that did not vote for it, uh, to reduce the federal funds rate to a range of 4.75 to 5%. Okay, half a base a bit. After maintaining it at the highest level in 2 decades for over a year. After delivering this verdict on Thursday, the Fed assured it was not an emergency response and unveiled projections that analysts say reflect conditions for the economy to achieve a gridlock scenario where growth is steady and inflation and unemployment stay low. Sweet. Okay. So, they had a dot plot, and everyone looks at this dot plot of where they think they put a dot where they think, in the next year inflation would be. And in June, just a few short months ago, four FOMC members expected no rate cuts in 2024. Seven members expected one rate cut in 2024, and eight members expected two rate cuts, okay, in 2024. So that was back in June. So yesterday, only two of the members had priced in two rate cuts by the year end. And remember, we're in September, October, November, December. We got a quarter left, basically. Okay. Seven more saw three rate cuts, and eight more saw four cuts by the end of 2024. Okay. And one lone Uber Dove, what they think is probably Goolsby, expects five rate cuts in 2024 in the next 3 months. Okay.
Five.
So what we have? Yeah, what do we have? Two more meetings, Fed meetings, And
Yeah.
so how did we get from, slow and steady, to, oh my God, it's not an emergency, but we need to cut rates because everything looks fine. Seems a little fishy to me. So Powell, started out his meeting by saying the U.S. economy is in a good place, and our decision today is designed to keep it there, said Chair Powell during his press conference. He also said recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, an available data point to roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient. How many times have we heard that? We've gone over consumer spending. They don't count in inflation rate. And investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and strong performance of the U.S. economy over the past year. So let's start with housing because today the existing home sales report came out. So I went over and looked at the existing home sales report. Now remember, the housing sector, improving supply conditions, which I agree, there's some more houses on the market, have supported resilient demand. Existing home sales in the U.S. fell by 2.5% from the previous month to a seasonally adjusted annualized rate of 3.86 million in August of 2024, edging down from the upwardly revised 3.96 million sales to mark the fourth decline of the year. The decline took place despite a drop in mortgage rates in the period, which contributed to a drop in the median existing home sales price around $10,200 to $416,900 on average price. Inventory of unsold housing rose and edged higher to the equivalent of 3.9 months of sales at the latest rate, picking up from 3.6 months from the earlier months. So what he just said with his own reports is untrue. Okay. Of course, yeah, housing would have more availability and the price went down a little bit, but we don't have anyone to go buy these houses now. No one's going to buy these houses. They don't have the money. And I'll show you why then. I know you said in your neighborhood, we talked about this yesterday, and you said, well, I wish you'd come down to my neighborhood and see how resilient the housing market is.
Right.
Correct.
There are more for sale signs in a 20-mile stretch of my house than I have seen in 14 years. It
And
is
they're not
insane.
moving. They used to
No,
move, right?
they're reducing prices. That's the only
Yeah.
thing moving.
Yeah. And they're not
Yeah.
even moving then. Yeah. I mean,
Yeah.
so there's this first fallacy, housing. Okay. I'm just using their own reports against. Okay, let's talk about growth. U.S. GDP. Real gross domestic product in the U.S., this is the last time they brought it, rose at an annual rate of 3% in the second quarter of 2024, up from 2.8% in the initial estimate and 1.4% in the first quarter. The upward revision was mainly due to increased consumer spending. Sweet, 2.9% versus 2.3% earlier reported. The increase in consumer spending reflected increases in both service and goods. Within services, the leading contributor to increases were healthcare. Okay, you got to go get healthcare. You just cannot say, I'm not going to
Right.
do healthcare. Well, I
Right.
guess you could, but it wouldn't probably good. Housing, okay, you got to put your housing, you know, and everyone needs to live somewhere. And utilities, okay, you got to pay your utility. So there's our big spending in GDP. Within goods, the leading contributor to the increase were gasoline and other energy goods, furnishings, and durable household equipment. Okay, so are we going out spending on Ferraris? Are we going out spending on vacations? And also, where does the GDP money come from? GDP, government spending now represents over 25% of GDP. So we're spending more. Where are the jobs coming from in GDP? Government jobs. Okay.
Right.
So there's another fallacy. If you look at the headline number, it looks good. If you do your homework, you look a little deeper, it's not so good. Okay. So there's fallacy too. Okay. Growth and then housing. Let's talk about inflation. So Powell said, inflation has eased notably over the past 2 years, but remains above our long run goal of 2%. Okay, so inflation has eased over the past 2 years. There's the price of milk, bacon, eggs, gas. Gas did go down, but it's not at the price it was 4 years ago. Okay.
Right.
Did the cost of your housing insurance go down? Did your property taxes go down? How about your car insurance? Did that go down? Did anything go down? Okay, to the level it was before? No. So he's just talking about the rate of change of inflation, and it's still
Right.
above their 2% year over year projection that they want to say that's good inflation. So if the price of your widget went up and it's up 30% or 40% from where it was 4 years ago, it's still going up by 2%, month over month. Okay, so
So
inflation is not whipped.
that number, everybody says inflation is at 2.9%. That is the rate for which it has
Going
is
up.
increasing
Absolutely.
month over month or year
Or
or
year over
year
year.
over year.
Yep. Yep. So estimates based on the consumer price index and other data. This is what Powell said. Estimates based on the consumer price index and other data indicate that the total PCE prices rose 2.2% over the 12 months ending in August. And that, excluding the volatile food and energy categories, because no one uses food, no one uses energy. Okay. Uh, excluding the volatile food and energy categories, core PCE price rose 2.7%. Longer-term inflation expectations appear to remain well anchored. I love the way they talk in their talk. Well anchored, as reflected in the broad range of surveys of households, businesses, and forecasters, as well as measures from the financial markets. Median projection in the SEP for total PC inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. These are their dreams, okay? So in reality, we don't have to go back too far. Okay, last week, the core CPI came out. That's the number the Fed uses. Core inflation, which strips out the more volatile food and energy components because no one eats and no one needs energy to, cool their house, heat their house, drive their cars, go out and harvest corn. Advanced by 0.3% on a monthly basis above the 0.2% predicted. Year over year, the core CPI remained elevated at 3.2%, well above the Fed's 2% target. This was last week. This was their report. It's going up. Core is going up. It's going up. It's going up. It's not coming down. PPI, core producer price of the United States, which excludes food and energy. Now, this is what manufacturers do. Okay, rose by 0.3% over a month in August 2024, compared with forecasts of a 2% increase. Okay, producer prices going up. Okay, we can look at manufacturing a little later. So, fallacy number 3, inflation's under control and going down. I see it ticking up, and I'm going to show you a chart. I think that Fed Powell may be our new Arthur Burns. We'll see. So, again, there was a recent study with inflation by savings.com, and it showed that nearly 80% of the US adults have cut back on groceries due to rising prices. But how can that be? Inflation is down. How can it be? I don't know. I'm so confused.
Total lie.
Yeah. With 37% reporting they're extremely or very concerned about their ability to afford enough food, and even more people are worried about the affordability of healthy food. So, housing, lie, growth, lie, inflation, lie. Okay, let's go on to jobs, because I'm sure he's correct on jobs, even though this chart behind me shows when they did their reduction of 818,000 jobs, it just poofed away, causing a 31.2% decline. Yeah, again, all right, I'm having hope that jobs, he said, is true. So Powell said, this is yesterday, overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. Well, when you're losing your job, of course it's not, okay? It's only when you're making more money and you have to hire more people and you have to pay more people money like you did during, the coming out of the COVID. That's when we saw that. The labor market is not a source of elevated inflationary pressure. The median projection for the unemployment rate in the S&P is 4.4% at the end of this year. Well, it's 4.2% right now. So that's inflation, unemployment's going to go up by 0.2%. That's from their number. Okay. Amazing. Okay. But remember, we're okay. The BLS, okay, in the report that we go over all the time, has admitted with its downward payroll revisions, the monthly increase in jobs in the past year was not 230,000 a month, as it had indicated previously, but $150,000 a month when one removes the 818,000 jobs that were never there in the past year to begin with, is down a staggering 31.2% off the headline numbers. Okay. Wow. Does that sound like the jobs are doing better? Okay. All right. In the last non-farm payroll report, which we just had, according to the BLS, while the number of employed workers did rise by 168,000, looking closer at the composition of this increase is disastrous. That's because it consisted of an increase of 527,000 part-time jobs, offset by 438,000 plunge in full-time jobs. We lost 438,000 full-time jobs. This means that since last June, the U.S. has added just over 2 million part-time jobs and lost over 1.5 million full-time jobs. So are we robust? Are we doing well? Okay. Because we all know part-time jobs pay far less, don't offer benefits, and they lead to some optimal outcome for the labor market, meaning they don't have as much money. Okay. One of which is the need to get more than one job. And sure enough, the number of multiple job holders, or people who, for whatever reason, have more than one job, jumped above 8.5 million back to all-time highs. So yeah, we can report all these jobs, but what kind of jobs are they? part-time jobs. Okay. And we can go on about, citizens versus non-US citizens. And I won't do that because, it's just another tick in the
Yeah.
lie of what they're trying to tell us. Powell also stated during the presser when he was answering questions that they have not seen significant company layoffs. What the hell world does this guy live in? We go over them every week. And we're talking thousands of jobs that these companies are
Yeah.
talking about. U.S. job cuts. The U.S. employers announced 75,891 job cuts in August of 2024, just last month, the most in 5 months, and the most for the month since 2009. What happened in 2008, 2009? When
I
excluding the
don't know.
pandemic-induced crash of 2020. That was a report that comes from the government. Okay, but no, jobs are fine and plentiful. We don't have a problem. All right, there's line number 4 for me: inflation, jobs, housing, growth. Okay, so those are the ones I'm going to go to. Let's just look a little deeper. What's happening with you and me, the regular guys? Let's talk about consumer credit. Okay, July consumer credit soared more than 25 billion to a new record high of 5.093 trillion. Looking at the components, the spike in revolving credit, that's like your credit cards, okay,
Yeah.
was most notable as credit card debt surged by 10.6 billion, the biggest monthly increase since February and the second biggest of the year. Okay, so what's happening? Well, let's just go to Ally Bank. Okay, they just came out with their report. CFO Russ Hutchinson of Ally Bank warning about a weaker credit and net interest income trends quarter to date relative to expectations. Specifically, Hutchinson said that in July and August, they saw auto delinquency soar a whopping 20 basis points compared to their expectations, while the net charge-offs, the NCOs, were up 10 basis points compared to their expectations. Over the course of the quarter, our credit challenges have intensified, Hutchinson said. Our borrower is struggling with high inflation, cost of living, and now more recently, a weakening employment picture. He also said that the firm may experience some underperformance, he said, adding that Ally will evaluate reserves to cover bad loans and increase them with needed. People are going out and they're expending their credit to the limits, okay? And they're not just buying stuff they want, they're buying stuff they need, like food, like electricity.
Right.
They're putting that on the credit card. On the other side, personal savings. Okay, we're talking about every time you hear the consumer is resilient, think about these things. Consumers are ever more strapped for actual cash and equity as the personal savings rate in the US collapses from over 5% to 2.9%, the lowest since the Lehman bankruptcy. In just 1 year, as all excess savings from COVID are long gone. So total credit card debt is at all-time high, while personal savings rate is at a record low. So remember, the consumer is resilient. Okay, the consumer and spending increases. The only reason the consumer spending is increasing is because the cost of goods and services have gone up. They're spending more for less. Okay, they're not getting 2 bags full of groceries for $50. They're getting 1 bag full of groceries for $50. Let's look at bankruptcy. Okay, U.S. bankruptcy filings spiked in August after a slowdown in July, propelling the total for the first 8 months of the year to the highest level since 2020. What happened in 2020? And the second highest since 2010, S&P Global Market Intelligence said Monday. Let's go on to U.S. budget deficits. For the first 11 months of 2024 fiscal year, the U.S. deficit increased by 24% to 1.897 trillion from 1.525 trillion in the same period of fiscal 2023, as the current year's interest costs on public debt topped $1 trillion for the first time. That can't be good for the economy, can it? I don't know. They didn't
Yeah.
bring it up. No one asked that question yesterday. No one asked a question about bankruptcies yesterday. No one asked a question about consumers and the consumer situation yesterday. No one asked a question about manufacturing. Okay, the ISM manufacturing PMI edged higher, okay, in August to 47.2, okay, from the November 2023 low of 46.8 in the previous month. Has to get to 50 before we're seeing an expansion. We're still in contraction, okay? Missing market expectations of 47.5 and reflecting the 21st monthly contraction in U.S. factory activity in the last 22 periods. The result extended the weak momentum for manufacturing in the U.S. economy, underscoring the impact of elevated interest rates by the Federal Reserve in that sector. Employment levels fell for the third straight month. On the price front, costs rose at a faster pace. Employment down, cost up. I thought that inflation is under control. I thought that employment is steady. Okay, these are manufacturing. Okay, which we need in this country. It's firmly above market expectation, expected to slow down to 52.5, challenging the Fed's hopes of disinflation in the economy. Employment's down, prices up. The U.S. manufacturing PMI service, the purchasing managers survey, okay, was revised slightly down to 47.9 in August from a preliminary 48, and continue to point to the most marked deterioration in the health of manufacturing sector so far this year. Production decreased for the first time in 7 months as sales continue to fall amid increasing reports of demand weakness. I thought the consumer was resilient. A renewed reduction in employment was also recorded amid sparse capacity in the sector. Also, demand for inputs would scale back in response to lower new orders, leading to a first shortening of supply lead times in 3 months. The pace of input costs, inflation, quickened to a 16-month high, with output prices also rising. Again, prices up, employment down. The U.S. budget deficit, okay? The U.S. government posed a $380 billion budget deficit in August, stark reversal from the $89 billion surplus in the same month last year, and compared with its forecast of nearly $350 billion shortfall. It was the widest budget gap since September of 2022, as outlays jumped 254% to a near one and one half year high of $687 billion, driven by a $129 billion increase in Medicare spending, $124 billion rise in Social Security expenditures. Meanwhile, tax receipts, rose only 8.3% to $307 billion, largely due to $137 billion in individual income taxes and $131 billion from Social Security insurance and retirement contributions. For the first 11 months of the 2024 fiscal year, the U.S. deficit increased by 24% to $1.897 trillion from $1.525 trillion. Okay, so here we go. You tell me, yesterday we had a whole Fed meeting. Okay, everything was rosy. The market is up today. Okay, so my question that I would have asked, and the only question I would have asked, because they wouldn't give me more than one question, if the U.S. economy is in such a good place, and those were the words of Chairman Powell, why did
Yeah.
the Fed feel its need to cut rates by 50 basis points or to cut rates at all? And I can tell you why. Because there are too many recession alarms going off, including an uninverted yield curve. We got the SAM rule, and we got history. When they start cutting rates, and they cut rates at 50 basis points, that's not normal. Okay, if things are
Yeah.
all right. Okay, 50 basis points means there's sirens going off somewhere. We also have an election coming up, and I think somebody wants to save his job. Okay, hate to put politics in there, but it's just, I'm calling it how I see it. By deciding to cut rates by 50 basis points, the Fed has effectively abandoned its inflation mandate. Okay, because we have an
Yeah.
inflation mandate and an employment mandate. They said inflation is under control, even though we've seen the CPI and the PPI, a core starting to rise. Okay. As details of the SEP shows that the distribution of participants' projections for core PCE inflation in 24 and 25 is expected to remain above the 2% target. Unemployment at 4.2% is expected to rise to 4.4% in Q4 and 2025 before going back to 4.2%. So, what I'm saying is Jerome Powell the modern day Arthur Burns? I still think we're heading for stagflation. And I want to show you one chart. Okay. And
All
this
right.
is an interesting chart. And then my rant shall cease. Okay. Sorry about my rant.
Yeah, it's all right. It's good.
Okay. But I think us regular people are like, what the heck are they talking about? What world do they live in? And this is the chart. Okay. This is the chart of inflation. Okay. When the Fed raises rates or cuts rates. Okay. So this is the red is where we're at today. And the green is back in 1883 or 1983 to 1984 when Arthur Burns was doing the same thing. They came up, they got inflation, they came back, they started lowering rates. Okay, and look what happened to inflation. The inflation in red is where we are today. You see it's gone down. You can see back in the day of Arthur Burns, okay, it went down, and we're following the same pattern. So if we follow the same pattern where Arthur Burns started cutting rates, you saw inflation go up to 11, 12%. Okay,
Holy cow.
before it came back down. Okay, because they had to raise rates again. They raised rates to get the inflation to come back down. Okay. And we're seeing if we're going to be on that same trajectory. So, maybe Powell wants to be the new Arthur Burns. I don't know. That's how I see it as just one regular guy. I was infuriated that they insulted the intelligence of regular people everywhere with the clown show they call the FOMC meeting. Okay. I can call it something else, but being a family show, I'm not going to do it. So there's my rant. How did you see
Well,
it?
oh, Mark, come on. So, Mark, I'm in the same camp as you. I watched that. There have been two on TV events recently that just drove me nuts. One was the debate, and two was Chairman Powell's speech yesterday or press conference. I don't see what he's looking at. I don't understand it. I don't understand I mean, I understand from the point of view if he came out and said, this is wrong, this is wrong, this is wrong, this is breaking, this is breaking. The whole market, equity markets, bond markets would just have a blow up. It would happen. But it's the lack of just a little bit of the truth. We're lowering 50 basis points, trying to get ahead of this because we do see slowing. We do see part-time jobs increasing versus full-time jobs. We do see the cost of groceries going up. We do see 90-day delinquencies on credit cards are up 15.91% year over year. Okay. We see that, but our game plan is to balance this out. It's going to be a little rocky road, but we're going to balance this out. That's why we're dropping 50 basis points. No, no, no. It's like everything's just, sunshine and puppy dogs. Everything's
Yep.
wonderful, right? So I watched it and I got to think to myself, I wonder what historically things look at. And so I start to look at this whole payroll thing. Number one, you see these two handsome guys?
Oh
There
my
you go.
gosh. Wow, we're in yellow.
We're in yellow
We've
because
got a
we're
glow.
we're nuclear right now. That's why. So the first thing I started looking at was this rate lowering of 50 basis points. Has this happened before? And what this chart shows you is going back to January 1st of 2000 of this, 24 years ago. This is the effective Fed funds rates. Now, he lowered rates yesterday, supposedly, but they're not reflecting in any of my charts or anything. And my question is this really, are we going to see the effective funds rate change in 6 to 9 months? Or will we see an immediate reaction in the next 24 hours or 48 hours? Okay. So first of all, so then I started looking back. When's the over time? When have they made this move? So in September 17th, 2021, 2001, they lowered 50 basis points. What happened after that? I'll tell you what happened. We had the dot-com blow up. Okay. September 18th, 2007, 50 basis point reduction. What happened after that? The great financial crisis. And
Hmm.
then yesterday, we have 50 basis point reduction again. All the same language that was said yesterday was said in the prior September of 07, September of 01. Are you thinking maybe this is a coincidence? I mean, hell, 2 of the 3 days are on the same date
Hmm.
and it's the same amount. So, and after each of these events, they continue to lower rates. Now, he talked about lowering rates upwards of 100 basis points or a full another 150
100%.
basis points by year's end. Now, I've heard also, was it Jeffrey Dunlock was on CNBC yesterday, and he says, I expect 120 basis point total move by year's end. That's aggressive. Their target by December of 2005 is 3.5 or 3.25 to 3.5%. That is a 200 basis point massive move in a very short period of time. But if the economy is doing great, why would you have to do this? Why would
Absolutely.
you have to take such drastic action? And so that got me to thinking, okay, well, what does this affect? This affects the prime banking prime loan rate. And that is what you have the federal funds rate, and then banks tack on typically another 3%. So if it's today at 5.25, they tack on 3%, it brings it up to 8.25%. Well, if they're going to reduce it, that brings down the prime rate. That rate is what they use as a base to calculate credit card interest rates. And the average credit card interest rate, if you have great credit, is 20 to 21%. If you have crap credit, you have 28 to 33%. You're not getting out of debt. And what did I say about delinquencies on a 90-day rate? It's over 15% delinquency. You're on 90-day delinquencies year over year is up 15.9%. This means people are maxing out their credit cards and they don't have enough income to pay for this stuff. Now, the average prime rate over time is 6.83%. We are well above that right now. So, does this affect you and I right away? Chances are not. If I'm a bank, like was it Allied you mentioned,
Yep.
and I think J.P. Morgan also sort of confirmed this, their net interest income off a credit card and these revolving debt or revolving loans, they're seeing an increase in delinquency rates. We just talked about that a second ago. And if you're a bank, are you going to lower your rate because of this prime rate adjustment or this federal funds rate adjustment in light of the fact that your delinquency rates are going up and north? No, you're not, because you got to offset this lack of income. So you're going to keep these credit card rates and revolving debt rates high. Is that good for the consumer? Did this Fed move do anything for you and I, the regular guys and gals of the United States? No, no. This is an emergency move on their part. Non-farm payrolls. Over the last 3 years, you look back, and we have seen a 16.9% hiring decline back into basically September of 21. 16.9%. That means less and less people are being hired every day. You hit upon this in your rant. Once again, this just says the economy is not strong. If I'm a business owner and my cost to produce a product goes up like it is, and the demand for my product or service is going down, guess what I'm not going to do? You're not going to see a job, ad for, job available, job opportunities. You're not going to see that. You may see it from a big corporation, maybe, but you're even showing that in our platinum calls every Friday. These guys are laying people off left and right. The number we have to focus on is not layoffs. And that was what Jerome Powell was talking about was, oh, the layoffs, we don't see it. You and I see it. We talk about it all the time. We see it. But the one thing we have to focus on that he didn't talk about was this decline in hiring. People are not hiring. Now, some people may argue that this is a product of AI and artificial intelligence, and we're able to replace the human being with a computer or AI program. No, no, they haven't. The only one company that has monetized AI right now is NVIDIA. That's it. Everybody else is just spending money trying to make this work, and yet they're spending money, the goods are going up, and they're laying people off, and the hiring's going down. AI is not the reason that decline in hiring is the thing. That's not it. The reason is because it's our economy is slowing. We are coming to a screeching halt. It's like, what is it, the Roadrunner?
Hmm.
And you see him just
Yeah.
right,
Yep.
right. That's where we're at. The only reason you get that aggressive with 50 basis points and then project that you will lower them again another 50 basis points within the year, and your target rate amongst all 12 of the Fed chairmen, is that 3.25% to 3.5% is the target rate for December of 2025. Why, if your economy is doing great, why would you do that? All it does is it's devaluing the dollar. If you looked at a dollar chart yesterday and you watch the dollar as he's talking about this, dollar drops. If the dollar goes below a hundred, or a dollar goes below a dollar, you know there's problems, major problems. The other flip side of this is 10-year US Treasury went up yesterday. It's up today. That's what your mortgage rate is tied to. So all of a sudden, everybody who I'm my buddies on Facebook who are mortgage guys are like screaming, "Hey, federal funds rate dropped 50 basis points." I'm like, "Yeah, but your benchmark went up. That's gonna kill your business, dude. That's what that's the demon in all this." And I guess this is where I go, nobody, and maybe it's a presidential election, maybe this is all political. I don't know. But at the end of the day, after November 5th and the election is decided, it's you and I, the regular guys and gals of this country, that are held holding the bag. And the politicians will get rich off this. They will. You've seen it for 4 years. Pelosi's made tons of money. All these politicians are making money. It's ridiculous. And I guess that's where I look at this and I go, what can you do? It's like you said today before we started talking, or on the video call. I just can't worry about it. I just can't worry about it. What can I do? Just adjust, position yourself, protect your family and your wealth. That's what we're doing. That's what.
Yep. Yep. No one
There you
else
go.
looks after your wealth as good as you do. And if you're not looking after it and you're pawning it off to someone else, you should probably go review that policy.
Right.
Yeah. I
Exactly.
mean,
Yeah.
this isn't my first rodeo and seeing what I'm seeing. And it's almost like deja vu. And I just can't believe we fall into these same economic traps,
What
you
gets
know,
me is
time after
just
time.
the dates of
Yeah.
these lowering of rates. It's like, I mean, coincidence, whatever. Maybe they schedule it on the 18th of September
Well, I mean,
most years.
they do have September meetings every year, but the fact that they lower on, 50 basis points,
And
is
then the
interesting. But
repercussions afterwards.
what comes after September, October? When do we have our big crashes? Where are all the big crashes? There always seem to be in October, so the
Yeah,
black, October crash,
right.
1987,
During the
it was October. I remember that
yeah,
one well. That was my first crash in the market.
wow.
It was
Yeah,
huge.
so I think it's just, you gotta just take a moment and look at the data. Don't look at the personalities. Look at the data. Look at the true data. Look at your personal financial data. Are you getting wealthier? Are you getting poorer? Are you seeing a strain? Are you feeling a strain? What can you do to protect yourself? At the end of the day, it's like, yeah, I can vote. I just, anyways.
No,
So,
I mean, we've got to look after ourselves, our families, our well-being. Okay.
yeah,
Because if we don't do that first, it's like, when you're in an airplane and they say put your mask on first before you help anyone else. Otherwise, you might pass out and then you're
yeah,
worthless to everybody. Um,
exactly.
I see, I see what I saw yesterday with, with the chairman of the Fed and what they were talking about was silly to me. I mean, I'm looking at, if I'm a pilot of an airplane, all my gauges are starting to beep and they're starting to flash. Okay. And I'm even hearing that little voice come on. It says, pull up, doot, doot, pull up. Because I think that's what they're doing with this rate cut is they're trying to pull up before they hit something. And
Yeah,
that's just me. It's my opinion. It's not financial advice. But just like Trent said, go out and look around. What's happening in your personal life? Are you better off than you were? Okay. Can you afford
yeah,
things? Are your neighbors getting laid off? Are you getting enough hours at work? Okay, are you working 2 or 3 jobs now to make ends meet? And are you not making ends meet even with that? I mean, they always say, when your neighbor gets laid off, it's a recession. When you get laid off, it's a depression. And I think what the Fed is really worried about is this unemployment getting out of control. And they're
yeah,
even talking about unemployment going up before it goes down. And
Yep.
that's because they know it is going up, and they're going to try everything they can to stop it. And rate and what cutting rates by 50 basis points is just their their panic way to do it, and it has no effect on employment.
No.
History shows you can cut the rates all the way you want. It's not going to help unemployment once that ship starts sinking.
Yeah. And I think and the thing is it's like it's slow before it just accelerates. And I think we're in that slow period. We're seeing the data, we're seeing the jobs revisions, we're seeing all of this come through, and we're slowly. And then yesterday was the aggressive move to lower rates to do something. That's sort of that, right just before you hit the vertical. And
Hit
you
the
may be
mountain.
right.
Yep. Yep.
October may be the big month. I don't know. I think this is where understanding more of what's going on and taking some time and paying attention and doing a little digging is very important. And to have a source that's unbiased, who's just looking at the data, to dig into this and look at it and then be able to make a judgment decision. I mean, if you could take this data and this information and put your logic to it, are you going to write it out or are you going to protect your assets? Are you going to hedge your positions? Are you going to preserve your 401k? Or are you just going to write it out? Because, like we've heard recently on one of our calls, writing it out was 13 years in the making.
To get
13
back to
years.
to get back to zero where he
13
was
years.
before. Yep.
Yeah,
And
he
that's
wrote it
happened
out.
time after time. And
Yeah.
again, it's just like a continuous cycle. And it's a telling trend. I have to dust off my economics degree from my land grant Big Ten University and try to look for some logic in what the Fed's saying. But I'm not a PhD in economics, but my degree is just enough to let me know that what I'm hearing is not kosher for me. Okay, and what I see in looking around is not it's not looking good for the economies. Okay, and if you see it different, write it down and write it down in the comments below. And we're not maybe we're wrong. Maybe we're wrong. I don't think so.
I ask myself that all the time recently. Am I just a pessimist? Am I off my rocker? But when I look at data, I look at numbers, math doesn't lie,
No,
you
it's
know.
it's being a realist, and I spent most of my career as an engineer
Mhm.
and analyzing data, and that's what I do. You say something, I'm going to go out, I'm going to back it up and verify it. If it's not verified, I'm going to ask questions. Okay, maybe
Right?
there's something I missed, but I'm not
Yeah.
seeing it.
Yep.
That's what I did with Powell. I went and saw said, what did he say, and what are the facts as I see it and
So just to
experience it.
let you know, the US dollar is down a quarter of a percent today.
Hey, but
Sitting at
The Dow Jones is up 600 points right now, and the
it's
Nasdaq's up 500 points.
because every
Woo-hoo.
institution's taking profits off this trade. Anyhow, all right, Mark, I think that's enough of
Ranting.
the truth.
Yep.
Uh
The
in the
truth is, two regular
meantime,
guys see it, not
that's
financial
right.
advice. Yeah.
That's right. If you'd like to learn more about what we do, come check us out at www.bus13.ai. That's bus13.ai. We have two subscription levels right now. We have Platinum, which is what Mark runs. It's swing trading strategies, charts of interest every morning. We do a swing trading
News.
call every Friday. Kerry's cheat sheet, bus portfolios that Kerry is focused on AI stocks, a whole lot of stuff. You then have the premier, what we're referring to now as gold, which is the premium channel. And we're changing that to the gold channel to stay in the metals market. And that
Gold's
represents
up.
Kerry's
Gold's
cheat
up today.
sheet. What gold's up today?
Yeah.
Why?
Yeah.
Why would gold be up if
Yeah.
everything's wonderful and great, right? No. Anyhow, so we got a little bit of a reduction in what we offer in that. And here soon enough, we're coming out with the silver plan, and we'll let you know more and more about that. But in the meantime, hit the subscribe button and the like button. Check us out at bus13.ai. That's www.bus13.ai. Put your comments below. We love to hear what you have to say about what we're talking about. We love to see your side of the picture, and we will not judge. We want your information. We want your input. So, in the meantime, from Mark and me, have a wonderful day and live loud. Peace.
And cut.